Okay, we're live streaming. I'm going to do a desktop recording as well. Trade alert, sell FNGU for 240% gain in 2023. That's the 5 stocks, leverage times 3 that have actually gone up this year. We had clients massively long this position. When we sold it, it was almost half, it was half the portfolio. So we've moved that to cash and we're waiting for the next big trade alert. What we're doing with the profits is buying EUO. This is long dollar versus the euro. And we're going to hold that until inflation starts falling. And it has been falling, but we're worried it might return because Janet Yellen is about to sell $1 trillion in debt in the next 6 months. This is likely going to make interest rates rise. As the debt ceiling is raised and the Republicans cave to the Democrats' wish list, there's a huge risk of rising rates and rising inflation soon. Our portfolio builder is outperforming the S&P 500 by 2,444% since inception, and we're outperforming the S&P 500 by 345% in 2023. And that's because SPY is up 9.37%, and our high-risk portfolios now hit a 41.75% return for 2023. Buy these stocks now to get rich ahead of the 2024 market cycle. And it's really the big race coming up, but if we say it, Google might ban us. So I think you all know what's coming up next year. So here's our current high-risk portfolio allocation while we see what happens when $1 trillion of debt gets issued in the next 6 months, at the same time that the Federal Reserve is still going to hike interest rates even higher and keep doing quantitative tightening because parts of the inflation picture just aren't cooling off, and now they're becoming worried it's entrenched in the economy. Now, we do think actually inflation will keep falling, but the amount of debt that's about to be sold does make me nervous that interest rates may rise quite soon. And if interest rates are rising, the dollar will crush other currencies, like we've seen it do in last year primarily. So I do think we could pull a nice profit on this, maybe a 20 to 30% profit if we do get another scenario where interest rates are rising too rapidly. Worst case, I think it trades flat until we're ready to buy the dip in the next big plays. So currently a unit of investment in the high risk portfolio is costing $4,404. In each unit, we're buying 42 shares of UVXY, the crash insurance play. I may add to that position next week. I just want to make today's trade alert really easy. Just sell FNGU and then buy EUO. So super easy for everyone to follow. And I do think oil is getting attractive once again, so we may add to that next week as well. And also long term, I think interest rates are going to be falling. So I do want to get more exposure to probably ETHE, Coinbase, or go back into FNGU. But I do think we need to be a little patient to get back into those aggressively. So currently we have, again, 42 shares of UVXY, 98 shares of TMF. That's the treasuries. We're only 17% long that in the high risk portfolio. To be clear, I'm a little more worried about the front end of the bond markets, interest rates rising, rather than the long duration bonds. That's why we're not dumping our bonds in either portfolio today. So TMF has 98 shares. EUO has 72 shares. That means you think the dollar will go up against the euro, which basically means we think inflation might fall faster in Europe than the US, which makes sense because we're about to, again, pass some massive spending packages through America, which is going to force our Fed to keep interest rates higher for longer and continue to do quantitative tightening. Meanwhile, and we're not seeing any slack in the labor market whatsoever yet. So there's just no reason to think things are about to fall apart from that side. On the offense, we still got a little bit. Again, about half the portfolio was in FNG. We sold that and moved it to a safe position in the dollar. Now we're long Coinbase with 17 shares, and we're long the big oil and gas companies, leverage times 3 with NRGO. Now it does look like there's been some monkeying around with the data. They revised the oil demand to be a lot higher than a lot higher than they had reported. And I think that was in an attempt to get the price of oil to go down so that the coming CPI print might be a little prettier. So I do think NRGU will soon be a good play for us to add to. And again, 1 share of NRGU, 17 shares of Coinbase, 72 shares of EUO, 98 shares of TMF, and 42 shares of UVXY. Now, if you're a paid member, you can log in where it says total to invest, input how much you want to invest, hit calculate, and then you can automatically see exactly how many shares to purchase. So again, we'll probably slowly be getting back into a tech position, getting back into NRGU, and adding to UVXY over the coming weeks and months as we watch this debt hit the markets and see how it impacts interest rates. For now, the dollar is a safe place to be ahead of this event. So we're sitting on a 20.19% return in May, a 42.42% return in 2023, and we're just really massively outperforming markets. Our safe growth portfolio has been a little bit of pain. So this one is sitting on the bond market. For the next 2 years, my conviction that bonds are going to go up extremely high is the safest bet you could possibly put money into. It's just been taking a lot longer to play out. So we've got a bit of a drawdown this month. The safe growth portfolio has most of its cash in the long end of the treasury market, and there's no plans to change that anytime soon. We're looking at a cost of unit of 1877 with 19 shares of UVXY, 114 shares of TMF. We're playing the beat up Asian companies with 12 shares of EDC. We've got 22 shares of GBTC. That's been this portfolio's best performer this year. And then we've got 1 share of NRGU. This portfolio most likely won't make any dramatic changes until we see the bond market start really going the direction we like. And at that point, we may add to all 3 in the offense, as well as a little bit of UVXY. This portfolio has a 14% drawdown, mostly because of the bonds and oil going down, which is unusual. Typically, if oil's going down, the bonds would go up, but both of those have gone down on us this month. So this portfolio is sitting on a small loss for the year. But again, I don't think we'd have to touch it at all for 2 years, and you'd be walking away with at least doubling, if not tripling your money because of that single bond position. If you'd like to learn more about our products and services, call Dean at 505-322-7515. If you're a paid member and you want to learn about our private equity product, Rebel Dividends, that opportunity is going to end June 30th. And that's because we're switching the format of how we're able to raise capital. So again, don't miss out. That product has been doing extremely well this year as well. And we think it's going to be the next top performing asset over the next 2 years. Okay, so let's check out what's in the news. Kevin McCarthy is about to pass. This is laughable. In a few hours, the House will pass the largest spending cut in history. So the reality is they're still spending money as if we're in the middle of the lockdown pandemic days. And so it's just going to be massive, massive, massive deficit spending coming through the US at unprecedented levels. And this appears to be getting pushed through today in the House and off to the Senate tomorrow. And then the spending begins. But what's more important is this means Janet Yellen's going to have to raise $1 trillion in 6 months with massive amounts of bond issuance. Now, I don't want to get too freaked out about this because we know what they're going to do next is bond buybacks. Janet Yellen's actually planning to manipulate the bond market next year ahead of the big race, and they're going to drive those interest rates lower into November. So this is typically when we get the big melt ups in things like BTC or ETH, as well as the NASDAQ, because they drive those interest rates lower. So that's exciting. It's just the very short term that we're being cautious and being very safe. So the probabilities of a rate hike on the June 14th meeting have jumped to 72% now on all this news. And again, 2 weeks ago is at 15%. With the way the data is coming in, we may have another rate hike even in July. So we may have 2 more rate hikes, which is just wild to even consider. But that's, again, going to affect the front end of the yield curve. And it could cause the long bond to go down and create a very inverse curve on the bond curve. So that's what we're worried about and watching over the coming weeks there. Now, why is the labor market so resilient? This is from Andres Steno Larson. Now, he thinks is going to end up with a depression type environment or earnings getting crushed. But here's the part of it that I do agree with. Why is the labor market so resilient? Well, it's basically not a surprise since the price of labor has dropped markedly in real terms. Price of labor dropped 10% relative to consumer prices through 2022 in many European countries. This makes labor cheaper for companies relative to selling prices. Bottom line, sweet margins. Yeah, so companies are still jacking up prices, seeing how much money they can squeeze out of the consumer, and they're not having any problem doing it. So this is why we have this massive labor shortage. We also have trillions in bank accounts of excess savings. We've got 5 trillion in money market funds. We've got something like 2 trillion in reverse repo. So the second inflation does cool off and bond yields fall, I'm actually looking for the stock market to boom higher, the opposite of what his prediction is. Now, here's Bank of America's forecast for inflation. They're expecting pretty much a drop to 3% by the end of the year. Now, this forecast may change with this massive spending coming through. We'll just have to keep close eye on it. This is looking at when the federal funds rate tops out. We're about to go above the level that led to the 2008 financial crisis. Now, again, that was a bunch of mortgages that were sold very, very corruptly and packaged together and given out to people who couldn't pay them. I'm not sure we have that type of crisis set up for us now. Most Americans have locked in ultra low interest rates with fixed rates. So I don't see something crumbling in the, at least the retail market. Perhaps the commercial market is different. But once the federal funds rate does top out, interest rates on the long end of the bond market top out and then crash lower. And that can either lead to a very good scenario or a very bad scenario, depending on why those interest rates are falling. Again, we believe the economy is fine. There's trillions of dollars sitting everywhere to go into markets. And those markets that are holding the funds are waiting for a clear picture that inflation is cooling off. And if we look at this, the long bond history over the last 40 years, you can see it's clearly heading towards lower and lower prices as the debt gets bigger and bigger and productivity continues to increase. And so we do believe this will head towards 0% rates on the long end by 2026. That's when you're going to want to cash out your big long bond position, and your $1 million BTC, I think, could be hitting around that time period. So again, we believe interest rates are topping out here. Inflation's topping out. Maybe it'll bump up a little bit in America for a little while because of this big spending package. But in general, we believe that companies are creating the goods and services more efficiently, and that inflation is going to come down. And that, again, the big move next is interest rates falling. This is looking at the money supply, the producer price index, and the CPI. And again, they have crushed the money supply after jacking it up. So you can see in 2020, they jacked it up massively and inflation rose, and now they have crashed the money supply. And now we're going to see everything fall towards zero here. So this is telling us we have a good year and a half approximately of falling inflation based on what's been happening with the money supply. One factor in the inflation print that has not showed up yet is that rent growth has slowed for a year, but in the official CPI data, which looks a year back, it's been rising the whole period. So we're about to see a third of the CPI falling dramatically for the next year. This alone should drive that inflation much, much lower. We're also seeing things like the Baltic Dry Index, natural gas and oil all falling, and even copper, even with the China reopening story, all these commodities and metals are not going up in price. This is, again, the producer price index leading the CPI by a month. This is predicting we're going to hit 3% CPI in a couple months. And once that does happen, bond market's going to really love it. Okay, let's look at some charts. Here's that 2-year. It's been all over the place. It's been as high as 5, dropped to as low as 3.6, jumped back up to 4.6. And again, that's because the economic data has been cooling off and heating up and cooling off and heating up, keeping everyone confused. Here's TMF. which again, we think is probably the single easiest way to make money over a 2-year period, going basically sideways over the year to date, down 2.86%. We do think you're going to make a ton of money in this the second that CPI really starts falling. Here's DXY. That's basically what you're playing with EUO, but EUO is this times 2. I wouldn't expect it to go above that 120 level we saw last year when we had the energy crisis due to the invasion of Ukraine. But I do think we could see it maybe get halfway there if this big amount of debt coming in isn't accompanied with falling inflation. So again, if we see the CPI on the 13th of June falling as Janet Yellen starts ramping up the debt issuance, people are going to want to buy those bonds because they think they're going to get the yield plus the appreciation on the bond. If the inflation is sticky on the June 13th and July CPI prints, the bond market's likely going to get upset and we're going to have interest rates rise and push that dollar a lot higher. So if that happens, EUO is going to make a lot of money. I don't see a huge risk of us getting killed on EUO in the next few months while we slowly sell it into positions that can make more money. Here's a look at the bond yield curve. You can see the 3-month is at 5.4, predicting that they will hike the interest rates from 5.25 to 5.5. And again, that's going to happen on June 14th. Probably guaranteed at this point that they will do that. There's a small chance they might say they'll do it in July and pause in June and wait to see if the data cools off. But again, with this huge spending package most likely getting passed in the House today and the Senate tomorrow, inflation expectations are absolutely going to go back up because this is a very aggressive spending package. As you can see, though, it's the front end of the bond market that's getting wrecked, not the long end. We have lower interest rates on a 30-year than you have on basically any other debt instrument the U.S. sells. So that's why we're not selling TMF. Here's that FNGU chart. The AI hype is unreal. It is very cool what's come out, but it's probably gonna take a long time for all those products to really generate profits. And so there's 5 stocks that have driven the entire stock market rally this year. All of them are in FNGU and leverage times 3. So we really hit the jackpot. Now, last year, the only thing you could have made money with was really oil or natural gas. This year, the only thing that's made money was tech, and specifically big tech with AI components. So what's the next big play? Will it be a recession with treasuries? Will it be a return of inflation with oil and gas? That's the big question that we're analyzing and trying to make the best composure of our portfolio for the coming 6 to 12 months. Now, here's Coinbase, which we're still long, so we still have some tech exposure. This is our favorite single company to own in the stock market, getting attacked by the SEC. The SEC has been afraid to actually take anyone to court. They've been settling out of court because I don't think they actually want to make the argument that the assets at Coinbase are securities. And if they were, why did they let them register as an unregistered securities exchange? So I do think that this will be settled out of court, and you're probably going to see Coinbase skyrocket as soon as that happens. So hold tight to your Coinbase position. GBTC, this trust has been trading at a discount, doing very well. This is the top performer for our safe growth portfolio, up 68% year to date. We see no reason to change that position anytime soon. Again, we see GBTC going up massively over the next 5 to 10 years. And really, it's when the long bond interest rate hits the lowest level we think, which we think could be around 0% over a course of about 5 to 10 years, when you're going to get that maximum price in this cycle. EDC is a lot like playing GBTC. You want interest rates to fall, you want the dollar to fall, and you want inflation to fall. So we had that at the start of the year. Then all the economic data came in really hot. So you can see EDC start off really well in the beginning of the year, and then has fallen for the rest of the year. And this is, again, the big companies in China and Asia and Taiwan that you have exposure to, leverage times 3. It's the EEM ETF times 3. Again, we think we're very close to that point in time where that's going to happen. Emerging markets are trading at a huge discount compared to the PE ratios of the US. And in our safe growth portfolio, we're more of a value investor, which is where EDC is at. Here's a look at oil. You can see it's just been dropping all year with no bid in sight. Most likely we'll see the Saudis and Russians and OPEC get together and do everything they can to stabilize the price. They do not want this going below 70. China and the US want it to go as low as they can, of course, and they've been dumping their strategic reserves. US is pretty much about out of what they can do on that respect. China has a lot that they could, but I do think that this trade will come back, that long term. We're going to have an energy crisis over the next decade to worry about. So we'll be slowly adding back to NRGU. Again, we made a lot of money on NRGU and BOIL last year. And I think at some point, probably leading into 2024, it'll be a killer play as well. So look forward to some additional plays into NRGU. I do like NRGU over BOIL right now. The world adapted to the attack on Ukraine and the massive amount of natural gas that came off the market, and everybody's overreacted to that. Now we have supplies at all-time high levels. We've got more natural gas than we know what to do with, so I haven't even considered getting back into BOIL anytime soon. Here's that long bond. You can see it's just way out of trend. We think this is headed towards zero over a 10-year period. And again, we've seen zero or negative rates in Europe and Japan. It's only a matter of time until the US bond market has to do that. And again, that's the only way they keep running these massive deficits. Taking a look at gold, just sitting at this very high level, not playing it currently, just putting the chart up here. We'll see how the gold market reacts to potentially rising interest rates from this massive debt package coming in. Also looking at silver in this chart, but again, no plans to make any trade alert there. UVXY has just been getting crushed with the 0-day options. Massive amounts of 0-day options are coming in and forcing the market higher. So until that trend reverses on itself, it looks like UVXY is going to be a very risky bet. We haven't really been adding to that for almost a year and a half now, but I do think it's getting to such extreme levels of low volatility that we should slowly start adding to it. So expect to basically start cashing out our EUO into a mixture of tech, UVXY, and NRGU over the coming months. Okay, the regional banking crisis seems to have calmed down. But again, with the $1 trillion of debt coming online, if that money comes from money market funds and reverse repo, it's going to be very bullish for markets. And if inflation's falling, people would love to get out of a money market fund and buy treasuries because then they can make money on the bond and the interest rate. If they think interest rates are going to keep rising, then they just want to be on the short end of the curve. So if inflation's falling, expect the money to come out of money markets and reverse repo and be very bullish. If inflation is not falling and it's staying sticky or rising, then money's just going to keep going to the money market funds and the whole interest rate curve is going to go up and it's going to be very bearish. So again, that's the primary reason why we took FNGU off today. There's the S&P 500 up 9.42% this year. Here's the NASDAQ leading everyone with a 31% gain. And again, that's almost all from 5 stocks that average a 45% return. Here's the IWM, the Russell 2000. Again, so it's a very risky period because we've only got 5 stocks pulling the whole stock market up. And again, everything's going to really rely on whether or not inflation is taming down or not. Okay, very good. So these economic charts I still have to update. But everything looks super healthy on the economy. The consumer's balance sheet is great. Their debt to savings rate is fine. Their income to debt ratios are fine. Everyone's locked in super low interest rates on their homes. And so yeah, I think it's really just a matter of time to watch the next few CPI prints. And if they're falling, we're really set to jet and we'll get more aggressive again. If the inflation continues to come in sticky or starts rising again, we're going to want to get really defensive because that means the Fed's going to have to jack up interest rates really high. Okay, so Yao says, what do you think? I think EU could make 20 to 30% and has very little chance of losing much. And it's a good place to put money until we move into something more risky. John says, remind us when the big move in TMF is coming. Yeah, as soon as the CPI falls, John, that's when the treasuries are going to fall or rise in value. Interest rates will fall. Jeff says, what's the CBDC going to do to the portfolio? Nothing. It's CBDC is just going to help the government spend money faster. So it's really just going to make their spending plans more efficient. It's not negative to BTC or ETH at all. If anything, it's very, very good. No, so yeah, FNG went up 276% this year. It may go up. Yeah, EUO is long dollar against the euro. We're not trying to get rich on that. We could make maybe 20 to 40% max, unless some massive crisis happens. Then the dollar could go up a lot more. Like, for example, nuclear war or something of that nature. Okay, very good. So that's really the plan for the week. We're going to slowly, let me go back to the portfolios and we'll just review one more time. In the short term, we're just concerned about the inflation falling and this massive amount of debt. So we're going to watch the 13th of June. We're going to see what the CPI is. If that's a big beat, that means the inflation is falling faster. Then I'd be happy to increase exposure to NRGU and coin, and maybe add GBTC or ETHE to this portfolio back. I think the AI story has been extremely overdone. So companies like NVIDIA are just trading at ridiculous levels. So I think that we should wait for a pullback in FNG before we re-enter that position. If the inflation comes in sticky or hot, the EUO is going to make us a lot of money. Yao says, do you think FNGU could go higher? I think the risk is it goes lower than higher in the short term. And we made a ton of money on it. So take the profit, bag it, and then sit back and we need to see what's going to happen when Janet Yellen issues $1 trillion of debt in 6 months and what the inflation is going to do over the next 6 months. She'll get away with it if inflation is falling to 3. But if the inflation's stuck at 5 and she's trying to raise $1 trillion of debt and the Fed wants to sell $150 billion of treasuries a month and another 50 billion in mortgages, well, then the interest rates are going to rise and it's going to crash everything. So yeah, the government really, really needs the inflation prints to come down while they raise this massive amount of money. And their estimate on the deficit was supposed to be 1.6 trillion for the whole year. And they already ran a $1.1 trillion deficit in the first 6 months. So they're on target to run a $2.2 trillion deficit this year, which is what, like 30% above the target or more. So they absolutely need inflation to fall while they sell all this debt. Otherwise, what happens is the bond market crashes the stock market and you get massive layoffs and then the tax receipts fall. The tax receipts are highly correlated to the value of the stock market. So it's critical for the US government that inflation falls and the stock market goes up, especially into the November race. So I think the next 6 months could be bumpy and then we get a melt up is basically what I'm expecting. As soon as the inflation is clearly going down, I believe the market's going to melt up. Specifically something like BTC or ETH, absolute melt up. John says we live in exciting times. We sure do. Okay, guys, very good. So next week we have a dividend going out on Monday to our Rebel dividend shareholders. Tuesday we do our live webinar, and then Wednesday we'll have the next portfolio builder webinar. So I hope everybody made a ton of money on FNGU. And again, if you want to get into Rebel dividends, call Dean at 505-322-7515. We can't take you after June 30th, unfortunately, unless you're a credit investor. And there's actually going to be an entire month blackout where we're not allowed to raise any capital at all in July as we switch to a different regulatory framework to raise capital from only accredited investors. So call Dean, at least learn about it, 505-322-7515. Okay, thank you guys so much, and we'll see you back next week.